Hello traders, James Stanley with StoneX and Forex.com. It was just about a month ago as we were coming into Q4 that I looked at the US dollar for reversal potential. Now, there were a couple of different drives behind that thesis, all of which remain true today. We also have a fresh higher high, a fresh 2-month high, just after the Fed's rate cut announcement this week. So, seems as though there's an open door for USD bulls to make a push. But it's the US dollar. The US dollar is a composite of underlying currencies. The big question is going to dial back to whether or not those other currencies are ready to show additional weakness. So let's look at the chart. Let's see where we're at and see how this can continue to go. First and foremost, drawing back to that last video that I had looked at, the dollar, we were right around the 97.50 to 98 area in DXY. That video was published on October 3rd. And at the time, we didn't yet have the bullish breakout of the falling wedge formation. Falling wedges are important for bullish reversals because it highlights a waning sense of bearishness, a diminishing sense of aggression from sellers while at or near fresh lows. And that's something that can often pan out or lead to a bullish reversal. It's precisely what had built last year. And I cited this in that previous video, the similarity between last year's episode and this year's. In last year's episode, we saw the Fed begin to cut rates on Wednesday, September 18th. At the time, the dollar pushed down to a fresh lower low at 100.22, and it stalled. It stalled into the end of Q3, and then eventually, as we came to Q4, this aggressive breakout took hold. And even with the Fed cutting another 2 times last year, the dollar continued to rally in a very big way, eventually topping on January 13th of this year. Now, as we came into this year, U.S. data did not seem very positive, and then fear of around tariffs led to the thought that the Fed was going to cut rates multiple times. That led to a strong sell-off in USD that ran all the way into that Easter holiday. April 21st, we set this fresh low in USD, and then that's around when the sell-off began to stall. Now, the falling wedge formation that we have in here, it's longer term, bigger picture. It took months to build, whereas this one took just about a month. But notably, as sellers have had an open door to go for that break, and there's been a lot of reason for them to do so. There's been the expected rate cuts from the Fed. There's been the push from President Trump to remake the Fed more in his liking. There's been an expanding, ballooning U.S. budget. Lots of different reasons for this to show continued breakdown. Yet when we've gotten down with an open door, with a fresh low, sellers have continually failed to take control. That's what leads to the weaker angle or pitch on the support trend line. Now, on pullbacks, bears have still been happy to take a shot, leading to these lower highs that have eventually broken. That break happened starting with the Fed's rate cut on September 17th. And as I looked at in that last video, we had this higher low that was holding in right in here, ended up remaining as a higher low, and that led into a fresh higher high, which led to another higher low, and then another higher high. So bulls have continued to drive this. We're now about 6 weeks out from that initial rate cut in September. And you can see from this falling wedge formation, buyers have an open door to make a push for a stronger USD reversal. Now, again, the USD is a composite of underlying currencies. So whether the dollar can muster strength, it's probably going to dial back to whether or not these other currencies can show weakness, which I'll look at in one moment. First and foremost, in USD, this is the major zone of consideration, the 100 level in DXY up to 100.22. 100.22 is that swing low from the Fed's rate cut last year, where the move had stalled. And then more importantly than that, that's what sets the current high in August. Notice we had that vicious turnaround on the NFP report on August 1st, right after that 100.22 level came into play. If bulls can muster a break above that, it's going to look clean and open for a run up to 102, and maybe even something more. If we look at this from the weekly, if we get up to 102, that's going to look like a bottom is in place, and the door could even open for something deeper, maybe even a run up to 105 eventually. But that's probably going to need to be accompanied with some stronger inflation data, but that's a couple of steps down the road. For now, 100 to 122, and then that 102 handle that set the high back in May. The bigger question here for dollar trends is whether or not Eurodollar bears can make a break. So going along with that mirror image theme, because the USD is the denominator in this quote, the euro is 57.6% of DXY. As we've seen that USD weakness theme price in aggressively this year, you'll notice that we had Eurodollar strength show in a very big way. Eurodollar bottomed on January 13th, the same day that DXY topped. As we had that Q4 reversal in the dollar last year, it showed in Eurodollar. Eurodollar had stalled at 112, and it lost 1,000 pips into that January 13th low. More recently, though, as we've had the stalling in the DXY sell-off, we've had a stalling in the Eurodollar rally. There's day one of Q3. We got a fresh higher high on the Fed's rate cut announcement, but again, that was the point of no return. It triggered a series of lower lows and lower highs that remains in place today. Now, the big level in Eurodollar is the 115 handle. 115 historically has held some importance in the pair. You could go all the way back, and I mean, you could see these multiple instances where it was like a sharp point of reversal, like on when COVID was getting priced in. It was this lower high before the bottom absolutely dropped out in 2022. More recently, it was this point of resistance that led to a pretty sizable pullback until eventually the dollar found resistance at that 102 level in May. So far, it's been supported. We get below that 115 level, that's where it's, again, going to look like there's an open door for Eurodollar bears to take a push, and I think that's something that's going to equate to that bullish breakout scenario in USD. Going down a little bit tighter, below 115, there's a couple of key levels to keep in mind. 113.92 is the 618 retracement of the May to September major move. But that price also is the exact swing low from August 1st. So a little bit of difference here. In DXY, I think we could be beyond 100.22, which was the high on August 1st, before this break happens. But if we get below that level, it's right down here at 112.75. 112.75 is important in Eurodollar, as that's the 618 of the 21 to 22 major move. It's the level that was the swing high back in 2023, set the 2023 high. And if we get all the way down there, that bearish trend is going to look as though it has a lot more healthy development going on. For USD strength, though, I'm still more partial to the Japanese yen. The Japanese yen is a 13.6% component in DXY, and this has been one I've been harping on in webinars for some time now. Because as we had that April swing low, that April 21st swing low in DXY, dollar yen set a swing low on April 22nd, just inside of the 140 handle. But more important than that, even though the dollar has set two additional swing lows below that swing, on day one of Q3, and then again on their rate cut announcement, notice the dollar yen has put in higher lows. This shows the addition of yen weakness. And so even though the dollar has been relatively weak for much of the year, especially since April, or had been relatively weak since April, dollar yen has put in a pretty healthy bullish trend. Now, chasing this higher is a challenge. There's been a number of bull traps that have brewed. But I looked at this in a video just a couple of weeks ago when we had this 150 test followed by a hammer, and bulls have absolutely taken control ever since. The next big level in play for dollar yen is the 155 handle. 160, I think, is going to be more of a challenge point. 160 is a level that we couldn't quite get up to earlier this year, again, right around that January 13th high in DXY. But 155 is a major point of reference in dollar yen, and I think we could possibly trade above that, trend above that. I would just get a lot more cautious as we get closer and closer to that 160 handle. 160 is where the Bank of Japan was ordered to intervene back in 2024 and eventually created this massive unwind scenario in dollar yen after an intervention following a US CPI report. But for the dollar, for USD, it looks like bulls have an open door to make a push here as we go deeper into Q4 trade. It's not quite to the same degree as what we saw last year. Last year, that reversal hit pretty quickly after the Q4 open. But notice where it was the pricing in of rate cuts that was really bearish for the dollar. Rate cuts themselves, especially when inflation was well above target, not as bearish. And that's somewhat of the backdrop that we have right now. But that's what I have for this video. Still looking on the long side of the USD, looking for bulls to continue this move. Thank you for your time. And as always, happy trading.